Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host, AlgoBot, and today we're exploring an expert advisor called Triple Advance Pullback. This is a selective, trend continuation approach built around a classic three-candle advance pattern, a trend-following moving average, and the average true range for measuring volatility. By the end of this video, you'll understand how the strategy spots a healthy advance, how it waits patiently for a shallow pullback before entering, and how it manages risk. Remember, this is educational content only and not financial advice. Let's get started. So what exactly does Triple Advance Pullback do? At its core, this expert advisor is a trend continuation system. It doesn't try to pick tops or bottoms, and it doesn't chase a market that has already run a long way. Instead, it looks for a specific footprint of strength, 3 consecutive candles that move in the same direction in a clean, orderly way. When that healthy advance appears, the strategy doesn't jump in immediately. It marks the setup as armed, and then it waits for the market to take a short breather, a shallow pullback, before stepping in on the resumption. The engine behind it is built from 3 simple, well-known tools. First, a trend baseline moving average, an exponential moving average with a default period of 50, which defines the direction the strategy is willing to trade. Longs are only considered when price is above a rising average, and shorts only when price is below a falling one. Second, the average true range, with a default period of 14, which measures how much the market is moving so that every threshold, stop, and target adapts to current volatility. And third, the candlestick structure itself, the shape and progression of those 3 advancing candles. This approach is designed with patience and controlled risk in mind. Every setup must be significant relative to volatility, but not overextended from the average, so there is still room to run and space for a tight stop. The pullback must stay shallow, and the structural stop sits just beyond the pullback extreme. If the implied risk is too wide, the setup is simply skipped. In terms of who this style suits, it's aimed at traders who prefer fewer, more selective entries over constant activity, and who are comfortable studying trending conditions on intraday or swing time frames. It's described with instruments like major currency pairs, metals, and indices in mind, on time frames from 15 minutes up to 4 hours, though the time frame is never hard-coded. As always, this is educational information, not financial advice. Let's walk through the exact logic step by step. Everything begins with detecting a healthy 3-candle advance. For a bullish setup, the strategy checks the 3 most recently completed candles. Each one must be a strong candle, meaning its body is at least 55% of its full high-to-low range by default, so these are decisive candles, not indecisive ones. Each candle must close higher than the one before it and print a higher high, showing genuine progression. Each candle must also open inside the previous candle's body, which keeps the advance steady and orderly rather than gappy or thin. And the 3rd candle must not be a climactic, oversized candle. Its body cannot exceed 3 times the first candle's body. On top of that, the whole 3-candle move must pass 2 filters. It must be significant. The span from top to bottom has to be at least 1 average true range by default, so it isn't just noise. And it must not be overextended. The closing price has to be within 3 average true ranges of the moving average, so there's still room to continue. Finally, the trend average must be sloping in the same direction. The bearish setup is a perfect mirror image. Once a valid advance arms the setup, the strategy waits, for up to 3 bars by default, for 2 things to happen. First, a genuine pause. At least 1 completed candle must close against the trend, the shallow dip. Second, a reclaim. A candle that closes back above the previous candle's high, while still above the moving average, and while the pullback has stayed shallow, giving back no more than 55% of the advance. That reclaim candle is the entry. If the pullback goes too deep, or price closes back below the average, or too many bars pass, the setup is discarded. Now risk management. The stop loss is placed structurally just beyond the shallow pullback extreme with a small buffer. If that implied risk is wider than 1.2 average true ranges, the trade is skipped as too loose. The take profit is set at a reward-to-risk multiple of that stop, 2 to 1 by default. And once price advances 0.8 average true ranges in favor, The stop ratchets to break even and then trails 1.5 average true ranges behind price, managed on every tick. Only one position runs at a time. Let's look at the actual MQL5 code that runs inside MetaTrader 5. At the top are the input parameters you can adjust in the strategy tester. Trend EMA period, defaulting to 50, sets the trend baseline. MinBodyFraction, at 0.55, defines how solid each candle must be. MinAdvanceAtr and MaxExtensionAtr control how significant, yet not overextended, the advance must be. Max pullback bars and pullback fraction keep the pullback short and shallow. ATR period feeds volatility into every calculation, while StopAtrMult RewardRatio, break-even ATR, and trail ATR shape the risk model. Now to the heart of the logic. On the long side, you can see the buy condition. It requires that a dip has been confirmed, that the current candle is bullish with its close above its open, that this close pushes above the previous candle's high, and that price is still above the moving average. When all of that is true, the code calls trade.buy with the fixed lot size, the calculated stop, and the calculated target. The short side is the exact mirror. The sell condition requires a confirmed pause, a bearish candle whose close is below its open, a close that breaks below the previous candle's low, and price still below the moving average. That calls trade.sell. For both sides, the stop is placed just beyond the pullback extreme using an average true range buffer. The risk is measured, and if it's wider than the allowed multiple, the trade is skipped. The take profit is then set at the reward ratio times that risk. Clean, symmetric, and rule-based on both sides. Let's bring this to life on the chart. The smooth line running beneath and through the candles is our trend baseline, the exponential moving average, and the price action is what the strategy reads candle by candle. Watch the left side first. Price has been drifting, and then the character changes. A first strong bullish candle appears, closing near its high. The next candle opens inside that first body and closes even higher, printing a higher high. Then a third bullish candle does the same, opening inside the second body and closing higher still. These three orderly, solid candles are the healthy advance the strategy is looking for. Notice that each one has a full body. Each closes above the last, and the third one is not an oversized, climactic candle. The whole move is comfortably larger than one average true range, so it counts as significant, and price is riding above the rising moving average, confirming the trend direction. At this point, the setup is armed, but the strategy does not chase. It waits. Now comes the patience. The very next candle pulls back and closes lower. This is the shallow dip, the pause the strategy needs to see. Crucially, the pullback stays shallow. It gives back only a small part of the advance, well within the 55% limit, and price holds above the moving average. Then the reclaim candle forms, a bullish candle that closes back above the previous candle's high while staying above the average. That is where the buy entry marker appears. The strategy steps in on the resumption, not on the original advance. The stop loss sits just below the shallow pullback low, which keeps the risk tight, and the take profit is set at twice that distance. From there, price follows through. The next candle extends higher, and the one after continues the move until it reaches the take profit target marked on the chart. Because the risk was small and structural, this is a clean 2-to-1 outcome in this illustration. Now watch the right side of the chart for the mirror image, a short trade. Price rolls over, and 3 consecutive bearish candles step down in an orderly way. Each closes lower than the last. Each prints a lower low, and each opens inside the previous body. Price is now trading below a falling moving average, so the strategy only considers shorts here. That downward advance arms a bearish setup. Again, the strategy waits for a shallow bounce. A candle closes up against the move, a modest pause that stays within the shallow retrace limit while price remains below the average. Then a bearish reclaim candle closes back below the previous candle's low, still beneath the moving average. That is where the sell entry marker appears. The stop loss sits just above the shallow bounce high, and the take profit again targets twice that risk distance. Price then continues lower, candle after candle, until it reaches the take profit target on the short side. Notice the symmetry. The long and the short use exactly the same rules, just flipped. In both cases, the strategy demanded a clean advance, waited for a shallow pullback, entered only on a confirmed reclaim, and defined its risk before its reward. That discipline, entering on the pullback rather than chasing the third candle, is the whole idea behind Triple Advance Pullback. Of course, not every setup plays out this neatly. In real markets, pullbacks can deepen and trends can fail, which is exactly why the structural stop and the shallow retrace filter are there. Let's wrap up. Today we explored Triple Advance Pullback, an expert advisor for MetaTrader 5 that looks for a clean 3-candle advance, waits for a shallow pullback, and then enters on a confirmed reclaim in the direction of the trend. We covered how the moving average defines direction, how the average true range shapes every threshold and stop, and how the structural stop, break even, and trailing logic aim to keep risk controlled. Remember, this video is educational content only and not financial advice. Trading carries real risk, and losses are a normal part of it. If you found this breakdown helpful, please like the video, subscribe for more MT5 strategy analyses, and leave a comment with the strategy you'd like us to cover next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.